On TikTok, on Instagram, you see a lot of influencers saying, become an S Corp, you'll save $50,000 in tax and this and that. And that's all great, but it actually has to make sense because there are situations where it actually won't save you and it could cost you thousands of dollars.
Hello. So today we are talking about when it's time to switch to an S Corp. I think this is something that, gets overutilized sometimes by people and underutilized in other cases as far as when to become taxable as an S Corp. So today we're going to debunk a few things that come up around transitioning to an S Corp status, and then talk through what we recommend net income threshold wise, as well as what people do wrong when they become an S Corp. And then round it out with some real life examples of how some of our clients have truly benefited from going from an LLC to being taxed as an S Corp. So Andrea, I'll let you start. What do you find are the biggest misconceptions when it comes to S Corp status transition?
So the first thing I can think of is the S Corp is a tax election that you make. So it's not actually what type of entity you are, it's a tax election. So you can be an LLC taxed as an S Corp, you can be a C Corp taxed as an S Corp, but whatever it is that you are, it's something that you need to run by your CPA to see if it actually makes sense. Because on TikTok, on Instagram, you see a lot of influencers saying, become an S Corp, you'll save $50,000 in tax and this and that. And that's all great, but it actually has to make sense because there are situations where it actually won't save you and it could cost you thousands of dollars.
For sure. And I think of one instance that we had with a client where they had a loss as a C Corp. And it was really doing this analysis of taking that loss as remaining as being taxed as a C Corp, or if it should have been an S Corp, and, does the benefit outweigh losing the loss, if that makes sense. And I think this is where you get in that territory of hiring the expert who actually knows and can lay out the scenarios for you.
With your situation.
For sure.
Yeah.
For sure.
So the S Corp saves you on Medicare and Social Security taxes. So that's the benefit of being a S Corp. If you are a sole prop or an single member LLC, you're paying all of your net income is going to Social Security and Medicare. When you switch to the S Corp and you put yourself on payroll, this gets a little bit technical, so stay with me. You're paying yourself a salary, and then you're only paying Social Security and Medicare on the salary that you're paying yourself. Yeah. Everything else is taxed at ordinary rates. So that's why you're saving so much in tax.
Yeah.
But there are costs associated with being that S Corp.
Yeah.
You're going to have to file an S Corp tax return, which will run around $2,000 depending on complexity, but that's the minimum that most CPA firms charge. Sure. You're going to have to pay payroll expenses, so you're going to have to set yourself up on ADP or Gusto or a payroll provider and pay in around $90 a month to run payroll. And then you'll also have to do your bookkeeping because you're going to now need a balance sheet to file your S Corp return, so you need clean financials to do this.
In addition to that, you're essentially prepaying taxes where you can kind of determine what your quarterly estimates are up until this point. And then now as a W-2 employee, you're paying the payroll taxes at that time too. And so it really can be a strain on your cash flow if you're not in the right net income bracket that we recommend. So often,
that's a really good point.
Yeah. Often we'll hear bookkeepers kind of say, oh, when your net income is 40 to 60K, and we don't feel like that is really where you can get back max benefit because of the strain on your cash. So Andrea, what do we typically recommend when it comes to S Corp?
We typically say over $80,000.
Yeah.
And you're right. Like a lot of people online will say you need to be making over 50, but we think that's a little bit of a stretch, and you're going to feel very tight on cash if you're netting $50,000 and you become an S Corp.
Yeah.
Because you're going to have to pay yourself consistently through payroll, and then your cash could be tied up with those payroll expenses. And we don't like business owners to feel like that.
And I think the other thing that causes a lot of confusion with like the, ordinary business owner is the difference between revenue or income versus net income. So when we're talking about net income being at 80K, we're saying you've generated whatever number top line less every expense that you have that is deductible on your profit and loss. And so that means like we're not talking about that top line revenue. We're talking about that bottom line after all is paid. You're still making a net income of 80K or higher.
Right. And even 80K, it's cutting it close. We prefer to see people above $100,000. If you're making $100,000 net income after expenses, we'll say, yes, for sure, let's make you an S Corp, depending on your specific situation. Perfect. Again, because it depends what state you're living in.
Yes.
It depends what you have going on for the next 5 years. There really are different things that need to be evaluated before you go and make this S Corp election.
100%. And also, one thing that I know causes people to maybe stray away from making the transition is the complexity of the transition itself. There's so many buckets to check, and one of which is the state requirements. So some states actually require you to re-register as this new taxable election. And so that will cost in addition to actually making the transition. So what we like to do is we like to plug all of that into our S Corp calculator and just show you, hey, if you make this transition and this is your reasonable salary and whatever, which is something I want you to touch on next, this is what you will initially save if you don't employ or deploy additional tax strategies. But I want to circle back on the reasonable comp. Can you share a little bit more about reasonable comp and why that's so important?
Yeah, so reasonable comp is basically what is reasonable for you to pay yourself as the business owner through payroll. And what that means is the IRS wants you to pay yourself through payroll so they can get their Medicare and Social Security. But if you're paying yourself too little, you could fall under a reasonable comp audit and put you at risk for the IRS to say, hey, you're going to owe all these back taxes because you weren't paying yourself enough. We didn't get enough Social Security and Medicare taxes for you. So there's different things that the IRS looks at to say, were you reasonably compensated? And that's your job duties, where you're located in the country, and also if you were to hire someone in a similar position as you, what would they be paid? So those are what they look at to see if you're paying yourself right.
And that doesn't mean that that's the only thing you can pay yourself, but that is the minimum you should be paying yourself so you don't run into a reasonable comp audit. But also there are tax strategies that we always recommend, pairing alongside an S Corp transition, because there's just more levers you can pull once you make that taxable election change. So one thing I do want to say related to that, you mentioned this to me and I thought this was fascinating, but it makes a lot of sense. But for S Corps, typically it's less audit risk unless you have a reasonable comp issue, right?
Right. One of the benefits of becoming an S Corp is actually you're less likely to get audited. So less than 1% of all S Corps are audited by the IRS. And that's just because the IRS doesn't have enough auditors under their S Corp division to do the S Corp audits. And so really you're benefiting yourself by becoming an S Corp because the IRS just is not going to pay attention to you.
Well, and coming from a prior auditor's like lens, I did a motion for a cap when I said lens for like glasses. But coming from that standpoint, the other part of it is there's a lot of requirements once you do the S Corp election. So there's less risk for them that you're not reporting things. And so when you're a sole prop, they really have no idea how much you're generating unless you get a 1099, unless you report it as well. So there's more risk as a sole prop being taxed as that than it is an S Corp for the IRS. So that's probably why, if I had to guess, why they deploy more people doing those audits versus S Corp too.
Right. I've actually never seen an S Corp audit. I've seen individuals who own S Corps get audited, but their individual tax return is audited and not the actual entity itself.
Interesting.
So really you're protecting yourself and what's going on in the business, and then everything else outside of that could get audited, but the business itself is really protected.
Yeah. Along those same lines too, when we run reasonable comp, this is like the minimum. And then we help you identify additional tax strategies for other ways to bring income into the home in non-taxable vehicles. And so that is why we always recommend that first year when you make that transition to invest in strategy, because we can help you identify reasonable comp. Also give you strategies to be able to bring that income that you truly need into your home in the right ways. And also you just have so many more levers to pull that I feel like it'd be a lost opportunity where you would only make that savings on the S Corp transition and not all the strategies you now get to use because you're an S Corp.
Right. The S Corp itself unlocks so many tax strategies that you can take advantage of. So, if you want to figure out how to do the S Corp election yourself or whatever it is, it does make sense to have someone help you put in place these tax strategies, because you can continue to use them every single year.
Absolutely. So that's why I always recommend at least that first year. And we're really in the business of getting you results. So like if we do not think you need tax strategy, again, we're not going to offer it to you. We're going to say, hey, you're good. You're set up. Just run this until your situation changes. But I think because there's so many levers we can pull with the S Corp election, I think we should do a whole episode on what it gets unlocked once you actually become an S Corp, because I feel like that deserves its own rightful place. Don't you think?
Let's do that.
I love it. So before we sign off on S Corp transitions, what are some like real life kind of savings you've seen with just making the transition, not even unlocking all the strategy you can use?
Just the S Corp election alone can save you, it depends how much your net income is again, but I've seen a client save $100,000 by making the S Corp election.
Yes.
And this isn't a tax deferral, so you're not just kicking the tax down the road. You're actually saving that tax and it's never going to come back to you. It's completely eliminating that.
Yeah. And I think that's important for people to understand, because I do know a lot of times when we're talking about election changes as well as tax strategy, people worry that it makes them more prone to an audit or more risky. But truly, it really allows you to take advantage of how the tax code is written. And we kind of just make it our business to know what's available to you, because one, we need to know it for ourselves, let alone for all of our clients. So if you are interested in seeing if the S Corp transition is for you, feel free to reach out to us. You can go to thornadvisors.com and just book a discovery call with us, and we can talk more about it and see if it works and makes sense for you in your state at your net income and so on and so forth.
Thank you.